Okay, today we're talking about cost segregation studies. So this is basically another kind of real estate buzzword that a lot of people talk about. And essentially what it is it's taking the total cost of a piece of real estate. So ordinarily when you purchase a piece of real estate, you have to chop up the cost between land and the building. The issue that real estate investors run into is they don't want to depreciate the building over the extended period of time that they're required to. So if you buy a building, if it's residential, you've got to take depreciation on the cost of the building over 27 and a half years. If it's commercial, it's 39 years. And so 39 years is obviously a super long time. So people say, I'd rather recover some of my cost faster than that and take the depreciation tax write-offs sooner than have to wait and do it over 39 years. So the way around that for a lot of people is to do a cost segregation study, which is basically paying an expert to analyze the building and say, okay, of the purchase price of the building, a lot of it was towards this AC unit, which is depreciated over X amount of years. And maybe some of it is for, the new driveway that was put in or something like that. And it's kind of chopping up all of the different parts of the building and saying, these are the components that were paid for. And these ones specifically could be valued at this dollar amount and can be depreciated over this period of time. So it's a way to accelerate the depreciation deductions that you take, which allows people to take higher write-offs. And so that's the main benefit of it, is kind of speeding up those deductions. Great if you have like a high income year, or if you maybe sold a property this year and you're looking for some deductions on your other properties. It might be worth your time and worth the money to pay for the study, because these things obviously cost money. The thing that most people don't realize is that if you are going to pay for one of these, you need to make sure that it actually makes sense for your situation. So if you remember from prior videos, a lot of people run into suspended loss issues, which is basically saying if you have too much in losses and your income is over 125 grand, a lot of people, if you're not a real estate professional, you aren't able to deduct any losses from your passive activities. Unless it's offset by passive income. So if you're the type of investor that's got maybe one or two properties that are already showing a loss and you're over that income threshold, getting this cost segregation analysis done is only going to increase deductions that will just be suspended into the future anyway. So a lot of those types of investors will come to me and say, should I pay for a cost segregation study? And I'll say no, because all you're going to do is increase the loss that we can't take in the first place, which yes, it could eventually be accelerated if we have a profitable year, but those types of properties tend to be ones that continue to be unprofitable for tax purposes over time. So you need to make sure it's right for your situation. If you have questions about this, or if there's anything we can help with to kind of analyze it, absolutely let us know. But when you're talking with the cost segregation experts, just know that they have motivation to want you to do the study. They'll tell you that the tax benefits exist, and a lot of times they do, but again, you don't go to the barber and ask them if you need a haircut. And it's the same reason that you should double check with your accountant to make sure it makes sense.